Welcome to the What Does It Mean podcast. I'm Lindsey Bell, and I'm here with my co-host Chris Versace and Bob Lang. Guys, it's almost the end of August. It's been a stellar month. The market's up close to 2%, which is almost unheard of because August is not typically a great month. So let's just dive right into it. Bob, what are you seeing from a technical perspective? I think the market's taken a lot of people by surprise, especially, the three of us have been pretty cautious over the last several weeks, given the news that we've heard from the consumer or the different earnings reports we've heard. What are you seeing from a technical perspective?
No question, Lindsey. The markets have really surprised everybody here, and I'm looking at, frankly, at a V bottom right here, which is kind of rare. We don't really get those V bottoms. What does that mean? That means the market took a sharp nosedive down, bounced, and basically picked up all that lost territory to create what's the letter V in the alphabet. So I think that it's interesting that the market has bounced back in the face of what we call the wall of worry, and wall of worry being that people are not convinced or believing that the markets can go up, and they can just continue to go up and rise and frustrate most people. And listen, what is the stock market all about anyway? It's about frustrating everybody, frustrating the bulls, frustrating the bears. As it continues to move, it zigs when everybody expects it to zag. It zags when everybody expects it to zig. And, most people, if they are just relaxed and patient and watch what's going on with the markets, with the economy, with fundamentals and so forth, I think they're going to be in good shape. But frankly, this rally has been, it's been rather interesting, but we did march down pretty sharply at the beginning of August and rallying back. But this time around, we've had some participation with the small cap. So that is oftentimes meaning that the market's going to move higher, all the way around broadly.
Yeah, it is pretty impressive. We had that big pullback and we're still up very significantly for the month, Chris. When you look at that performance, it's kind of like we almost forgot that already happened. What are you seeing though from a fundamental perspective? Are the fundamentals there to support it? Is there good news? I know the Fed meeting's coming up. That's like one of the biggest things that we're anticipating. We're going to talk about it later in the show. But what are you seeing? Are the fundamentals there?
I think it depends on, like any other time in the market, Lindsey, it depends on what you're looking for, right? What you're invested in, because you can find areas of strength. You can find areas of concern. We talked about this on the last episode of the podcast. But what I think is going to be very interesting, and we'll talk more about this, I think, in September, is the upcoming conference season. And I say that because we're going to have, 2 months in the can, 2.5 months in the can, depending. Companies will have that much more data. They'll be that much closer to understanding what the Fed is likely to do. And it gives them a chance to kind of, I won't say reset guidance, but kind of tweak their expectations for the September quarter and really for the balance of the year. And you have to remember it's one of those factors why I think September can be kind of a challenging month for folks because, institutional investors, the horde, if you will, they're back from the beach. They're taking a fresh look at the data. They're sharpening their pencils and they're getting ready for what's to come. But between now and then, I think we're going to be stuck with some low volume days as we close out August, Lindsey. Business as usual.
Yeah, business as usual, although we're getting into September, which is seasonally the weakest month of the year.
Yeah,
so it's going to be fun, I'm sure.
It's not only that, but, depending on the last couple of days, the S&P 500 forward multiple on earnings peaked out at 23.4 times. That's the biggest number since 2002. That's almost unheard of. And we're back to knocking on that door. And I would toss it back to Bob. The market's, near term overbought, right, Bob? So folks should be a little wary as we head into this seasonally weak month.
After this huge rally we've had from the August 5th lows, yes, the market is in the short term pretty well overbought. But remember something, overbought's just a condition. It doesn't necessarily mean you have to sell because it's overbought. It simply means it's a red flag. It's a warning. We have to raise the flag and pay attention because we'll have a lot of volatility coming on. Speaking of volatility, a lot of volatility this week. Why is that? It's because we are in front of a holiday week. A lot of A traders on their desks are gone on vacation. Maybe they've gone to the Hamptons or wherever they go to celebrate for Labor Day holiday. And a lot of B traders on the desk have been instructed to DNH, do no harm, to their portfolios. And if they can do no harm, then they come out of it after we come back on the other side of September 2nd, which is Labor Day weekend. And hopefully things start getting back to normal in terms of volume, in terms of volatility. But for now, I think, the next 4 or 5 days, we're going to be seeing a lot of volatility.
Yeah, no, I think that's right. So, why don't we take a little bit of a break and let's gear up, because we're going to talk about what could be some of the catalysts for the market in the next month or so. First, we're going to talk about the Fed and interest rate expectations, what they are going to look like for the remainder of the year. Second, we're going to talk about AI spending and adoption. It's been a hot topic. We saw some volatility around earnings for AI companies. And thirdly, we're gonna wrap it up with a fun topic. We're going to talk about what does it mean to be wealthy now? What's your number? Think about it through this break. What is your number to be wealthy, Chris and Bob? We'll see you right on the other side. Welcome back, everybody. We're going to dive right into what the Fed said and what they're going to do in the months ahead. All right, guys, we heard from Powell at Jackson Hole. I think he did a really good job of threading that needle, right? He gave the doves what they were looking for. And I think he basically set the tone. We are shifting course. It's official. He said it, that we're entering the next phase of monetary policy where we're going to start reducing rates. He's ready for it. He cited the cooling labor market. He cited inflation that's closing in on the central bank's 2% annual target. But before he spoke on Friday, the expectations were 100% that there was going to be a 25 basis point cut. And now there's a little bit of a split. There's actually what I find interesting, a small contingent that's looking for a 50 basis point cut in September, just under 30%, which is notable. I mean, that's a little something. What do you guys think? Chris, let me go to you first. What was your take on Jackson Hole, and what are your expectations for rate cuts for the remainder?
I'm going to give him the grade of no duh. In other words, he did exactly what everybody expected he was going to do. I certainly didn't think he was going to, show, here's the playbook, everybody. This is what we're going to do at each meeting. So I think he set the tone well. But on the other hand, I have to say that, for the most part, I've been a Powell fan. And I say that because if you really listen to what he says, right, he's pretty much telling you what they're going or not going to do. I think the big issue is the market likes to superimpose its own thinking on Powell's words. That's typically where it tends to get into trouble. But I do agree with you, Lindsey, that the big question now is, 25 or 50 in September, but there's a bigger question too that ties to that. Is it 100 basis points before the end of the year, which is what the market sees? And as of now, right, because, we have to evolve as more data becomes available, but as of now, I don't see it. I don't see 100. I can see maybe 50, right? Maybe 75, but 100 is a big swing in my opinion.
Yeah, no, I totally agree with you too. And Bob, I want to come to you on that same topic too. We've got 3 meetings before the end of the year. So that means if we're getting 100 basis points of cuts between now and then, one of those meetings is going to have to show a 50 basis point cut. For me, I think the catalyst to get a 50 basis point cut at any one of these meetings, which I don't think is going to happen, but I think to get that, you need to see a negative jobs print. Negative. Not just 50,000 jobs were added, negative jobs.
Yeah, I agree with that 100%. I think if the jobs report that comes out on September 6th, which is August, is weak, very weak, that would be something else, because 119,000 jobs created in July. If we come up with a negative reading off of that, I think that would certainly be the impetus to have the committee push a little bit further towards more of a stronger message with their rate cuts. But listen, I'm in the same camp as Chris. I'm thinking maybe 2.5. I mean, if you go back to the June projections, the committee came out, and when you look at, take an average or a composite of what the committee was looking at for where the Fed funds are going to be at the end of the year, roughly 2.5 rate cuts. And I think that was being pretty generous. I think it's going to be more like in the camp of 2. I agree with Chris. I think his first one is going to be in September. I think the next one is going to be in December. But let's look at the Fed funds futures market for a moment. Having a really strong, bold prediction of 4 rate cuts to the end of the year. We have to remember back what happened earlier in 2024 when it was looking like 6 seven rate cuts in early 2024. And what did the Fed do? They poured cold water all over that. And all of a sudden, in about 2.5 months, 3 months time, it was dialed back to zero, actually. And actually, if you go back to May, the Fed Fund futures were predicting zero rate cuts in 2024. So I think the Fed did a really nice job of dousing that enthusiasm with cold water. And now we're back to the same sort of thing again. And what will the Fed do that one more time? I think the message from the Fed is expect rate cuts. What's interesting, Lindsey, is this: if you look at the timeline out there for rate cuts, the Fed Fund futures are looking for close to 200 to 225 basis points in cuts by the end of 2025. I think in November of 2025. I'm looking more at a more gradual approach. I don't think they're going to be done raising or cutting interest rates until 2026, probably March or April of 2026. So you're talking about a good year and a half from now before they completed their mission here. But
so, hey Bob, let me just say this. You can't even call those forecasts, right? And I say that because, and we all know this to be true, that based on, the rolling data, these expectations are going to get reset and reset again. You talked about it in January. I think what it means for us as investors, and that goes for you too, listeners, the upcoming data is going to be important. It's going to be important as we lead up to the September 18th conclusion of the Fed's policy meeting. We're going to get the July PCE price index data later this week. We'll get the August PMI data, the August employment report, July construction spending, and some other data, just in the next, 2 weeks. So we'll have a much better sense of the economy. But, to put any faith in those numbers out a year from now when it comes to rate cuts, forget it.
Yeah, I mean, I think you did a nice job there, Chris, tying it in a bow. What does it all mean? I think it means volatility for the market going forward. And just to put a pin in it, the Fed will be giving their new dot plot, their series of economic projections at this September meeting. And they had 4% unemployment locked in for this year. They had core PCE inflation at 2.8%. So there's going to be movement in that. And the market's going to react, I think. So
no doubt.
Good talk.
Great.
Good talk on that, guys. Let's move to another fun topic, okay? AI adoption. All right, we just got through the earnings season, Chris. Mm-hmm. And obviously all eyes were on AI. What are companies spending on it? And what is suddenly we've got religion on what the return on investment is.
Well, yeah. I mean, look, if you trace back to, earlier this year, even a little bit last year, AI became the new buzzword. Every company management team started dropping it into their earnings conference call comments. It would be fun. How many times did they say AI? Blah, blah, blah. So it became, I think, kind of an overused term. And, companies had to say, of course we're doing something. Everybody else is, we are too.
Even if we're not, we are, right?
Exactly. I think my favorite one that I like to goof on was Danone, the European yogurt company, and how they're going to use AI to determine new yogurt flavors. I'm thinking, taste buds work very well. Why do we need AI? But anyway, coming out of the June quarter earnings season, we heard from big tech that they're continuing to spend. I'm talking about Amazon, Meta, Microsoft. Who am I missing? Amazon, Meta.
Alphabet.
Thank you, Lindsey. That they're going to continue to spend building out their AI and data center capabilities. That's of course good for the chip companies, including NVIDIA, that will report later this week. But when we try to wrap our arms around how big or how much spending is going on, IDC came out with a new report that says that by 2028, the spending relating to IT and business services is going to double, $632 billion. Now, I got to be careful because I just got on top of Bob for long-term forecasts, right? So it's fair enough. I think that, we got to take this a little skeptically, especially since the U.S. Census just came out with a study that said only 5% of businesses are actually using AI recently. So it's kind of a on the come, if you will.
Yeah, it is on the tongue. And I think it's funny. There's a recent survey that also came out that, as I was looking around that from the Journal of Hospitality Marketing and Management. And like you talked about, you kind of joked about everybody saying they're using AI in their products, whether it's yogurt or running shoes or actual technology, right? Well, the reality is in this survey, they found that when AI is mentioned in the marketing of a product, in the marketing of it, mind you, it's, it lowers trust from the consumer, which then means that it decreases purchase intent. So that's something to keep in mind. And I wonder, it made me think hey, is there going to be suddenly a new trend of companies that are hey, we're AI free. This is our competitive advantage. I mean, it might work better in consumer product type of companies, but I mean, there is a trust element to it, right? People don't know what to make of technology they don't understand.
There's also at the risk of using, being a little bit of a potty mouth. I think a lot of folks are thinking some of this early AI is bullshit. I say that because we're only starting to hear about these large language models really starting to work. Alphabet, Microsoft, Perplexity, these other tools coming. So you really have to wonder, how is it a vacuum cleaner already has AI built into it? How is this possible? So I think there's a little bit of folks kind of pushing back going, yeah, I don't think so, or this is not the real deal. It's not fully baked. Call it what you will. Bob, you were going to say something?
Forgive me for being a little bit naive when it comes to AI. I still have not figured out how AI is going to make my life any better. I really haven't. I mean, I maybe it's going to speed things up. Is it going to make me smarter? Is it going to get me information quicker? A lot of those things, listen, Chris, I know you and I were around way back in the .com times when what was the big buzzword? It was B2B and B2C, right? Remember, I remember seeing a presentation at Bank of America back in 1999. It was going to be a $50 billion market, right? And at back 25 years ago, 50 billion was a lot, and people were it was way out there. I know we're talking about trillions with AI, and that B2B went bust. Now, I'm not saying AI is going to go bust here, but I still find it hard to believe that it's going to improve my life. And then, especially when it comes to stocks and so forth, I just wrote down 4 names here that I really don't think rely on AI, and they're at new all-time highs. So I'm looking at you, Costco, Lilly, D.R. Horton, and 3M. I mean, where's the AI with these companies? Maybe they're using it. Maybe they're buying some of the software or the chips. I don't know, but I don't think that their main businesses, the revenues or earnings, are being driven by AI. Am I right or not?
No, you're right, Bob. What I'd say is you are not alone, believe it or not. So Microsoft did a workforce study, and they said that 60% of leaders worry that their organization's leadership lacks a plan and vision for AI. And when you talk to the leaders, 59% of them, they worry about quantifying the productivity gains of AI. And the survey also found that individuals, worker bees, are bringing their own AI to work. That's probably an acronym too, BYOAI, I don't know. But they're bringing their own, but they don't want to tell their bosses, oh, I just shaved an hour off of my day, 2 hours off of my day because,
So Lindsey, are you saying someone is sitting there sneaking Perplexity or Claude on their phone, getting their work done and then typing it in or emailing it to themselves? Is that what you're saying?
Yes, I'm saying that too. And the other thing that this survey found is they said AI is breaking the glass ceiling, meaning that these young bucks that actually understand AI and know how to use it and they find it fun to figure out, they're getting promoted very quickly because nobody else knows how to use it.
This all sounds vaguely like the early days of the internet. You remember all sorts of ideas were getting funded back then. We're reading almost daily about new AI applications getting funded. And I wouldn't be surprised if we see this follow a similar development curve, probably compressed a little bit, right? Mm-hmm. That actually makes me a little hopeful about the long-term applications for AI, because there's all sorts of stuff that we use the internet for that we never thought we could have back in, us old men days, Bob, of 1999, 2000. So, did you think you'd be streaming video?
No.
Streaming audio? No. So there's bound to be applications that come along, but it could be a little bumpy ride before we get there. But let me ask you this though, because I did come across a stat that was kind of mind blowing. Right? We all hear about OpenAI and everything that it's doing, but there's one firm out there that said that OpenAI could lose as much as $5 billion this year because the cost of running its models. And for frame of reference, that's about a tenfold increase from what they lost in 2022. So I think a lot of these companies need to figure out revenue models. So here's my question to both of you. Would you subscribe to a monthly AI service? Call it Gemini from Alphabet, Amazon if they have one, Perplexity, like I mentioned, Claude, or a few of the others. What dollar amount are you willing to spend a month? $5, $10, $20, $25?
I would say for me, it's about what kind of tangible product am I going to get?
There's no other, Bob. There's no other. Give me a dollar amount.
Oh, I mean, I wouldn't.
You could say zero. You could say zero.
I'm going to say zero because, I mean, listen, I mean, I can go with a monthly subscription to Netflix. I can go with a monthly subscription to the Apple Store because these things are tangible. These are things that are going to help me feel better about myself and improve my life. I can even go for an Amazon Prime subscription or a Costco subscription. These things work to help me. Again, I'm still trying to figure out how AI is going to improve my life here.
Chris, Bob is aging himself out of this conversation.
Old man Bob, how do you turn this on? What does this do?
How did I suddenly get old?
We're lucky he logged into this podcast, I think.
I think you're right. Yeah. So what about you, Lindsey? Are you intrigued at this? Would you sample one or more of these?
Yeah. So I am intrigued with it. I've used free versions of all the different, AIs that are out there. I'm also like a slow to adopt type person. But what I would say is it depends on what I'm using it for. If I'm using it for work, I expect my employer to pay for it. Okay. So that is number one. And number two, if you think about it, everybody's getting hyped up. You like it to pull a stock into it. Everyone's getting hyped up for Apple because that's going to be really the first consumer interface usage of AI that people are going to be able to easily understand. But the problem with that is when people think about buying their cell phones, already they're very expensive. If people don't understand AI, getting back to even that survey I talked about, if they don't understand how to use AI, they don't understand the benefits and the detriments to it, they might not be so anxious to hop on. Of course, you have your early adopters to buy the new phone. People care about the camera, right? They care about like the battery life. So I don't know what that impact is. And Tim Cook's been like reserved. He's like, it's too early to tell. Because I think there are analysts on the street that are talking about how this is the big opportunity for Apple.
I think that's an opportunity for them to drive another subscription business model. But I think to Bob's point, I think the vast majority of folks are kind of scratching their head going, sounds interesting, but how am I going to use this? And, I'm happy to, dive into new technology. I'm part of the alpha, beta user group. So I'm always happy to test these things out. But, I don't need AI to rewrite my email. Like, thank you very much. I can handle that, right? I don't need that. So I think the real key here is for not only Apple, but these other companies to show use cases, right? Real world use cases that the average, Jane or Joe can use that might help foster this adoption. Other than that, I think it's just going to take a long time.
So Bob, let's wrap it up. What does it all mean? From a capital spending perspective to a consumer usage and marketing perspective, what does it mean for investors?
Well, I think the AI revolution here is still a land grab. I think a lot of these companies out there, they're trying to grab as much real estate as they can, right? And it much like the gold rush days back in the 1850s when I was a young guy. It was the same sort of thing going on. People trying to grab as much land as they could before it went away. I think the jury is still out, though, on how it's going to benefit. But the spending seems to be pretty big and pretty bold. It's very real. And, if the predictions are true, it's going to be a huge revolution for some of these companies. We're just still in the early days of things. Taking some risk right now for some of these companies is what they do. And I think that eventually this is probably going to pay off in a nice way. Probably about 20% less than what it's people are really hyping it up to be, though.
Makes sense. Chris, you have anything to add?
Yeah, I just want to know what the X is so I can figure out what X minus 20% is. That's all.
I'll let you know later.
You can let us know next week. All right, let's get on to our final subject of the day. What does it take to be wealthy, guys? Charles Schwab, they released a new survey that found that Americans believe it takes $2.5 million to be considered wealthy these days. That's higher if you're a boomer. It's lower if you're a Gen Zer. But I mean, if you think about that number, 2.5 million, it's a big freaking number. It's up 14%, by the way, from last year. Last year, Americans believed it only took $2.2 million. But when you put it in the context of retirement savings, the savings rate in this country that has fallen since pre-pandemic levels, what is your take on this, Chris? Is it achievable, 2.5 million? And is that the number? What's your number?
Well, I'm like everybody else. I'm working with my, financial folks to figure that out. It's kind of a moving target depending on what you want to do. It's also a question of, do you want to be, quote, wealthy or just comfortable? But I would say that, something, it's also some other moving parts too, like what's happening with Social Security. What's your investment portfolio look like? What kind of dividend income are you kicking off? It's, in my opinion, Lindsey, it's very tough to come up with a specific number, but I would say that, that $2 million range probably isn't a bad number, plus or minus, depending on where you want to live. Like if you're living in New York City, $2 million is not going to cut it, right? If you're living in Boise, that might work out just very well for you. But my other reaction on this, Lindsey, is that, the disconnect between what that expectation is and what people actually have saved, that's fantastic for us. And what does it mean? Because folks are going to have to tune in and pay attention to what we're talking about.
No, absolutely. I think investing is a very important part of reaching your retirement goals. It's nearly impossible without it. Doesn't mean you're going to be a multimillionaire overnight, but
no.
Thoughtful, methodic ways of investing make sense. But Bob, what about you? What is your thought on the state of the consumer reaching these wealthy targets? If I look deeper into that Schwab survey, 21% of Americans say that they think they are on track to be wealthy. 21%. And when they grade themselves, they ask them to grade like themselves A, B, C, D, F, failing, based on how much they've saved, how much they've invested, how much they educate themselves about personal finance, how well prepared they are for retirement. Most of them grade themselves pretty high. Like they have beliefs that they're doing the right thing. I mean, there's some room for improvement, they believe, but overall, they think they're doing all right. What's your take, Bob?
Well, first off, I'm glad you said it was 2.5 million instead of 2.5 billion. That would be quite a bit of a difference over there. But there's a lot of billionaires out there. I think that 2.5 million is probably pretty good if you're approaching that retirement age of maybe in your late 60s. I think you have to also consider the demographics and the longevity of lifespan. People living much longer. I mean, we have a lot of people who are not just octogenarians, but they're septuagenarians, I guess, that not living into their 90s, even longer than that. So you have to make that stash, that pile of money, of cash, of investments work for you for as long as you possibly can, right? And so if you add in the wealth and the retirement function, does it come out to be about 2.5, 3 million? I think it's pretty good if you're looking for a lifespan to be in the late 80s, early 90s. But how do you get there? I mean, my kids, like Chris's kids, are just getting started with their careers. And they don't have very much money saved up, but they're asking me, which is a really positive thing. Hey, Dad, what do I do to get going, and what goals should I be making for myself, and how much should I be saving every single month? And that, it is encouraging to me because, I'm going to spend all my money. I'm not going to leave any of it for my kids. No, it's not true. But
wait, are Chris and I in the will? Maybe we come in above your
head. Not yet. We got to get sponsors. We got to get going here, Lindsey. We got to crank this thing up.
That's right.
Let me just use that. Let me use that quick break, Lindsey, because as I'm hearing Bob talk, I'm just thinking about this. When we talk about wealth in this survey, how is it being defined, and how do home prices fit into this? Do you know?
Well, so that's what I was. They say 2.5 million, and I think from Charles Schwab's perspective, they're thinking as net worth, and I think as an individual, they don't really see it that way. So I was looking too at some of the retirement numbers you pulled, and I was thinking that home values have gone up so substantially over the last several years, even stock prices, right? And so because of that, I think people's net worth, despite what you see in a retirement account, is a lot higher than what is just simply on paper. People forget that that's an asset that they have that can fund their retirement lifestyle. I mean, we all have kids here, like you're living in a house that houses children too and other family members. But when you get old, you probably don't need that much space. So I think that's an important question, Chris.
Yeah. I think his name is Harvey Dent, who was very big on using demographic analysis. And he joked, I think he joked, that you don't save any real money until your kids are out of the house.
I believe that. There's a reason too. And in the survey, you see that it's the Gen Zers. They believe that the level of wealth for them, their goal is $1.2 million, I believe. Whereas like boomers, the older you get, the higher that number gets. Like boomers, they say 2.8 million is the number to be wealthy. So 1.2 versus 2.8 is pretty interesting.
So that's Lindsey,
differential that has to get filled, right? I mean, obviously, there's a lot of time there that for the Gen Xers or Gen Zers to catch up. But I mean, that's a huge gap, right? 2.8 to 1.2. That's a huge gap.
Yeah. There's one stat that I uncovered when getting ready for this conversation, and this is shocking. But the median retirement savings for an American household, you know what it is, Bob?
Is it 87,000?
Yeah, I know you can see the notes. There's no way you were going to guess that. Yeah, it's 87,000. So, when you think about that number, and again, it's just the average, trying to get close to that $2.5 million number, boy, that's pretty daunting. But, I think what you said, Lindsey, is spot on, that folks need to be investing to grow their nest egg. You don't necessarily have to put thousands upon thousands of dollars away every month. You can get started in a very easy fashion, just, putting some money away, starting with a simple index fund or a couple mutual funds or even an ETF. And then as you get a little more comfortable, and I'm sure this is something we'll talk about on future podcasts, you can start to wade into individual stocks. Maybe as you get even more comfortable, you can start flirting with options or something else, right? Of course, you got to be mindful of your own needs, your disposable income, as well as what most important, your own risk tolerances are.
Yes, I was going to finish your sentence for you if you didn't. But no, I think it's just important to, I think maybe I can just sum it up and like, what does it all mean? It's really, what does it mean is that financial education and financial literacy is so important. Because I think we become a country of it doesn't matter, I'm just going to work forever. Like we were starting to accept that mantra because of what Bob talked about, living a lot longer, and what you talked about, not having enough saved. And so I think that we need to start to like reverse that mindset to, I am going to retire and live out my golden years in the best way possible. And that's being financially secure. And that also means, what we do every day is try to, make the case for investing early and often, because it is, the saying as it goes is it's about time in the market, not timing the market. So that's my summary. Why don't we go to a quick break here? We'll come back with our big takeaway. All right, welcome back everybody to What Does It Mean? The podcast. You heard a lot from Chris, Bob, and myself about where interest rates are going, what AI spending means, and what the number is to be wealthy. Bob, let's start with you. What's your takeaway? What did you learn today?
Well, I learned that I have a lot more savings to do. Otherwise, I'm never going to retire. I'm going to keep working until I'm in that pine box, hopefully Hopefully not, but I have a lot more savings to do. But some of the numbers that you talked about, you and Chris talked about here, they're eye popping. They're really very sobering statistics here, right? People are just not ready and prepared to retire or become be considered wealthy. $2.5 million, is that considered wealthy? I don't know, but certainly you have to take the wealth and the retirement hand in hand. And I just think that people, their expectations are very, very high, but their reality is far from it. And I think that that in and of itself tells us, that more people need to be invested. They need to be learning more about it, and education that you talked about as well too. So that's where I'm. That's what I learned today.
Yeah, and you know what? I think that the folks listening to this are in the right place to close that gap between that $2.5 million, whatever their retirement goal is, and where they are today. But Chris, what was the biggest thing that you learned? What was most surprising about our conversation today?
I think that Bob valuing Netflix more over the potential disruptive future value of AI. I knew he was an old man. Now it's just confirmed.
Yeah, that kind of shocked me too, right? Now we know who we're working with. Anyway, for me, the biggest takeaway I had really was that we've been talking about this for several weeks, volatility in the marketplace. The volatility has all been on one side so far in the last couple of weeks anyway, on the upside. But there are a lot of things that are going to move the market, especially when it comes to the anxiety around the Fed, interest rates, inflation, and the jobs data. So we've got a fun month ahead of us in the month of September. With that, I think we could just go ahead and wrap it off. Thanks for joining us for this episode of What Does It Mean, the podcast. We will see you right here next week at Advisorpedia.